Man, so many people have been in my DMs recently asking me, Kieran, how is it you're getting those pinpoint sniper entries? First things first, what we're going to do in today's video is break down exactly how I get these pinpoint entries with a method I've never shown anywhere online before. So if you're here and you're ready to transform your trading, grab a notepad, grab a pen, because we're about to get into the source of things. Before you say, oh, he didn't take the trade, like we literally covered these levels on our live calls. So I don't know what you expect me to say. Apart from you can actually come and see these trades live inside the Master of Coin Inner Circle, where we go live twice a week, every single week. Because when I show you this, I want you to understand that just because you see this play out in the market doesn't mean it will work every single time, because you have to take into effect the context of these scenarios. You have to pay attention to things like macroeconomics, fundamental analysis, other pieces of confluence. Like, this is not just a magical thing that you can find this one method on the market and it'll work 100% of the time, right? You have to understand the bigger picture and how this fits into a larger plan. But if you're trading Wyckoff methodology similar to me, you can use this strategy to get those pinpoint entries and minimize your drawdown. Let's firstly go through the theory of things, and then I'll explain exactly how you can get these similar entries like I caught on ES futures. So firstly, let's go to the drawing board. So before I can show you and reveal this strategy, you have to understand this one thing first, otherwise it's not going to make any sense. So what you see on screen here is the daily trading net revenue for Goldman Sachs. And what you can see here is that majority of the days of the year, they are profiting millions and millions of dollars. There's actually less than 14 days in the entire trading year that these banks and institutions are going to finish with an actual net loss. But why is that? How can they actually come in and profit millions and millions and millions of dollars when we're sitting there struggling to even grow a $100 account? Well, it's understanding how they actually facilitate their orders. You see, Goldman Sachs institutions, they're not sitting here on TradingView like us and, doing technical analysis. They're running an algorithm, and that algorithm is what is going to facilitate price, and it's going to allow them to fill their orders over time. So obviously we don't have access to that algorithm, but what we can do is train our eyes to understand when this algorithm is present. So understanding that when these guys come in and they do their fundamental analysis and they determine their market direction, they build a narrative on why they want to buy or accumulate or distribute a certain commodity, a certain currency, or a certain market. Once they've done that conclusion, then they have to hedge themselves into the market. They can't just come in and just buy on MetaTrader 4 because one, they're trading so much money, and because they're trading so much money, they physically need large enough liquidity for their orders to be filled. You see, in this game, it's 1 for 1, meaning for every buy order, there has to be a sell order to match that. So if an institution is going to come in and place a bunch of buy orders, there has to be enough sell orders to physically sell them the contracts so that they can buy it. Now, using that knowledge, we can apply that to the charts. So what they'll firstly do is they'll come to a key zone. How do you find a key zone? That's a conversation for another day. But once they've come to that key zone, what you're going to find is that they'll firstly spend some time, right, allowing time to pass and opinions to form in your zone. Now, usually this is called consolidation. Now, during this consolidation, again, time's passing, opinions forming. So what happens is we generate liquidity under these areas. And liquidity is just a fancy word for money. It's like areas where orders are resting, open orders. Now, it's not John's stop loss with his micro lot size, because you really think a fucking institution who's trading hundreds of millions of dollars cares about Bob with his 0.01 loss. Of course not. They don't care what retail traders are doing. But what you have to understand is you'll have pools of liquidity. Liquidities are areas where high amount of orders are resting. So what they're going to do before they come in, right? They're going to sell the market down before buying it back up. Now, what this is going to do is a few things. Number one, it's going to allow them to bring the market down to a discount. Because why would you buy something at $100 if you can buy it down here for $30? Doesn't make any sense. So they're firstly going to sell the market down and enter a bunch of sell orders. And then once it comes to their price point where they've managed to fill all their orders, now remember, they're not just going to buy one order down here. As they're consolidating the market, they're filling and splitting up their orders over time. But when they give this final shakeout and manipulation, they're entering more and 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 more buy orders as prices come in more into a discount, so they're getting a better entry. Then, once they've filled all of their orders and their final buy order has been put in, you'll see the market now reverse, because now demand outweighs supply and obviously the price is going to rally. So then you'll see the market obviously shoot off to the upside. But why is this important for us? Because we have to understand that when they enter these sell positions here and they enter these buy positions here, how these institutions get these high profits is because they're hedging, right? And they're not using stop losses. Now, obviously for you, I'd recommend using a stop loss because you're not an institution. But they don't use stop losses because they can move the market. They physically have enough buying power to move price where they want. So once the market has rallied and price is now sitting up here, for example, we understand that they've got open sell orders and they've got open buy orders. But if the market is now sitting up here, we clearly understand that those sell orders are going to be in a loss. Now, don't worry about the exact numbers, but just know that obviously if you take a sell here and the market's sitting up here, you're obviously going to be in a loss. Now, if you're an institution and you have the power to move the market, are you going to keep that loss and take it on paper? Of course not. What you're going to do is you're going to bring the market back down to your entry after you take some profit from your buys. And then once you've now closed out those sell orders or in a loss at break even or in a slight bit of profit, now you can continue with your original bias and your original move, because now you've closed out all your sell orders and there's only buyers in the market. So the market will now continue in its original direction. Now we understand mitigation theory and what these guys are doing. They're always selling before they buy, or they're always buying before they sell. It's the exact opposite. What we can now do is use a very simple tool to get these pinpoint entries once we've identified these key manipulations. Now, if you want to increase your success with this strategy, you need to make sure you have the validation principles that come before you use this tool. I did actually do a free training on this. If you go down to the description, you'll be able to see that training in detail and see more of these confirmation criteria completely for free. But what we can do now is we can come in and identify that sell to buy movement. Now, it's not just going to be one candle. It's not going to be an ICT order block or any of that rubbish. You want to look for the entire movement. And what you want to do is use your fibs with these settings here, just a 0, 0.8, 1, and 0.5. And you want to come in and measure the entire sell to buy movement. Now, again, most people when they use fibs, right, they're taught, fib the entire swing. But guys, this is wrong. Why do you think the fibs don't work for you? Because you've been taught backwards. You've been taught to measure the effect. But why would you want to measure the effect when you can measure the cause? It's like in health and fitness. Everyone's worrying about, oh, I've got this illness, I've got this sickness, but you're looking at the result. Why don't you look at the cause and what actually caused that problem? So it's the same thing with the market. Instead of fibbing up that movement, the impulse, you want to fib up the sell to buy movement that caused that impulse. So what I'll do with my fibs is I'll measure from low to high of the sell to buy. And then in the future, we can look for mitigations of the 50 or the 80% to get those pinpoint entries. So when I come in here, what I'm going to do is I'm going to measure out from low to high when they sell to buy. I'm going to extend this out to the future. And now what I can do is I can look to take an entry off the 50 or the 80% of this manipulation. Now, the easiest way to do it is take one entry at the 50 and split your risk and put your stop loss below the 80 with another entry at the 80% and your stop loss below the low. Now, sometimes, look, you have to use a bit of critical thinking. Sometimes I would just take an entry off the 50 with a stop below the low. It all depends on the time frame I'm on and it all depends on the risk to reward. Sometimes if there's a lot of imbalance around the 50% and there's no confluence, I'll just have a limit off the 80%. But of course, these are other little key, these are other key confirmations which will come a lot later in your journey. But essentially, this is the easiest way. And what I'll be doing now is setting these limit orders, waiting for price to come back, and this is how we get those pinpoint entries. Now look, before I show you the example in the chart, go and backtest this yourself. Don't take my word for it, even though this is a strategy I've been using now for almost 5 years. But go and backtest this on the chart. Watch how often these key levels get hit. And then once you're done, you can buy me a coffee. So this is a trade we spoke about in our community where we go live twice a week, every single week. Now, of course, we initially come into our key zone. Now, how do I pick this as a key zone? Well, remember what we're looking for. We're looking for those areas of accumulation, right, where they build out their trading range. And specifically here, what we get is our manipulation, that last sell before we buy. Now, again, most people with fibs, right, they're going to measure this impulse, but that's wrong. What you want to do is get your fibs and measure from low to high of that manipulation. And you can extend this out in the future and use the 50 and the 80% for areas of points of interest. And look at that. Look how precise the market is when it comes to this key level at the 50. But of course, you're thinking, well, how did you get a 1 to 19 risk to reward, Kieran? Because you just said, if you're taking an entry at those 50, your stop loss is below the 80, all right? Same target, that's now a 1 to 3. Look, I'm not getting out of bed for a 1 to 3. So what I use is multiple time frame confluences with using higher time frame points of interest for lower time frame entries. So all I did now, if we drop down to a lower time frame, identified that sell to buy movement. Remember what they do? They sell before they buy. And given this is the right time of day, we can split our risk, one on the 50, stop loss below the 80, with another entry at the 80, stop loss below the low. And then we can use this to target our new swing highs. Now, of course, I'm not just going to be holding full volume to these highs. We are going to go into more trade management. And then from there, as long as this comes in at the right trading window, we're good to take the trade. And we can see, look at that, price comes right into our 50%. And just look at the precision on these levels. We see barely any drawdown. Price comes in, taps into the zone. After 10, 15 minutes, we see the market begin to rocket and go towards our target. And before you say, oh, he's a replay trader, he didn't catch this trade. I don't really care, mate. You're not my tax advisor. I've got nothing to prove to you. No, but realistically, these trades were all documented with inside the Master of Coin in a Circle, where we went over all the plays literally live before they occurred. And you can use the same thing for the sell model, right? It's just identifying your point of interest, identifying your key levels, and then using these 50 and 80 zones, right? Come into your manipulations, finding that buy to sell movement if you're looking for a sell, and you can use your entries off to 50 and 80% for absolute precision. And even now, when the market moves forward, you come in, right? Once you've created a new reaccumulation, you find that sell before they buy. If you want to get your point of interest, you measure it up, sell to buy, and wait for price to come to that 50 or 80 in the future. And then when she does, you can look on your lower time frame for more confirmations. You can see, look at that. She comes right back to the 80%, reacts off the 80%, and then creates a new high. Now, in here, this didn't meet my lower time frame entry criteria. I couldn't actually get an entry in here because again, I'm not just going to come in and measure a random manipulation. There's a lot of key pieces of confluence I need to have before I measure and choose that manipulation for it to actually be valid. So if you want to know more about those confirmations, you can go into the description and you can watch my free training where I literally give you the exact blueprint I followed to become a full-time trader for almost the last 5 years. But don't take my word for this. Go on the charts, identify those manipulations, measure them out, look for your reactions of that 50 and 80%, and then thank me once you're done. So if you did like this video, don't forget to drop a comment. Let me know one thing you liked, one thing you learned, and also don't forget to subscribe because we've got so much more content coming soon. From trading trainings, live market analysis, market psychology, fundamental analysis, to even just conversations with entrepreneurs we're going to start having on this channel. I'm super excited for the future that this channel holds. So make sure you are here for the journey and you don't miss the next videos that are coming out because, we got some bangers lined up. Now, if you do have any video requests or things that you're struggling with in the markets, psychology, life, entrepreneurship, whatever that may be, just drop in a comment and I'll be sure to help you out on the next video. With that being said, thank you for your time. Thank you for watching. It's been the Master of Coin, man. I'm gonna see you at the top, from the top, because you already know that bottom is way too crowded. Sheesh.